Yes, my name is Nadeem Keshavjee. I'm the president and founder of Greenbirch Capital. We're a commercial mortgage broker that's active across the country, placing financing transactions for developers and owners of commercial real estate, all asset classes, including multifamily. Well, look, I would say times like this, it's important to understand that we're in a cycle. So it's about thinking about where in the cycle we are right now. And I think we're in a bit of a challenged part of the cycle, but it's important to remember that it is a cycle, and where there's ups, there's downs, and when there's downs, there's ups. And so when you think about that, the part of the cycle that we're in right now, I think it's really important to play defense. And that means to me, looking at your buildings and thinking about the quality of your building. So whether it's a new building that you're building, or even if it's an older one that you have or that you're planning to purchase, it's about looking at what can you do to have it compete as well as it can with other buildings. And so times like this, it actually makes sense to invest in your building and make sure that you're competing really well against other buildings. And also, you also have to think about things like the right strategies in times like this. So that means the amenities that you have in your building, the amenities that are in your community, how far away you are from transit, the type of, what are your floor plans like? What type of tenants are you looking to attract, and are you serving them? Things like that in this part of the cycle are more critical than ever. So I think that's one thing to really pay attention to right now. And then the other thing to think about too, right now is, it's a volatile time out there, and different asset classes compete for capital. So if you really think about the stock market right now, it's really volatile with what's going on. And same with bonds. And often, bonds were often a natural hedge or alternative to stocks. But in the current environment, they're not. They can both go down just as easily as they both go up. And so it's challenged to be in that space. Places like sectors like gold are doing well, but you can only put so much of your portfolio there, and there isn't any income in it. And so that's where real estate becomes a really compelling value proposition in times like this. And then within real estate, a couple of asset classes like industrial and multifamily have been really popular with investors for a while, but the industrial sector has been really challenged with what's going on with tariffs, even more so than multifamily. And so that leaves multifamily as a really compelling asset class within real estate. And then within that, I think Western Canada multifamily has really good risk-adjusted returns, meaning when you compare to other parts of the country, areas like Toronto, Western Canada has a lot of really good things going for it. Affordability, for example, in Calgary and Alberta, Vancouver is a really great city in terms of lifestyle. Really good risk-adjusted returns, and in the overall scheme of where people can place their assets right now, I think Western Canada multifamily is really compelling. Well, look, there's a few things I would say there, and we're on the eve of an election. We're really close to that, at the time of this interview here. So a couple of things I would say is one, specifically when it comes to the financing programs, the MLI Select program has been a really attractive program for many developers and owners of multifamily real estate. But thinking about really taking a big step back and thinking about how affordability is defined. As an example, the program defines affordability in Edmonton at $1,665 a unit, and in Vancouver at $1,673. It's an $8 difference between the two markets, and they're on the opposite end of the spectrum, with Edmonton being the most affordable and Vancouver being one of the most expensive. And so really giving some thought to what that means, because the unintended outcomes of that are that it's really hard to achieve affordability in that financing program in Vancouver, and much easier in Edmonton, where in fact Vancouver needs it even more than Edmonton does, if you really think about the disparity between incomes and rents in the Vancouver market. And so really giving some thought to, before the MLI Select program was the MLI Flex program. I'm talking 4 or 5 years ago now. And that program actually had affordability defined as having the revenue of a building being 10% below market rents. And so when you think about that, as opposed to, defining rents relative to affordability and making it so hard to hit, to me that's something to really look at considering bringing back, because to solve affordability isn't just about having an idealistic notion of where rents are relative to incomes in a certain market, but it's about incentivizing more supply and still creating affordability that way. So when you create more supply, that is one of the biggest forces that'll help affordability happen in the market. So I think looking at that program and how affordability is defined will be really important. Not to mention that the way the program is designed incentivizes really tiny micro studios to be deemed affordable, when really you can have much larger units that are desperately needed become affordable as well. So I think looking at that definition becomes really important. And then thinking about a couple of things with the two main parties that are vying for the election. The Liberal Party have talked about prefabricated housing, and their platform mentions $25 billion going towards prefabricated housing, a lot of which includes modular. So I think if they come into power, it's really important to pay attention to that. But specifically, I'd hope that financing is really thought through, because when it comes to modular housing, modular companies require deposits up front, and then the modules have to be shipped to the actual site before lenders are generally comfortable advancing any of their construction loans. And there remains a big gap between who finances that cost between the time that it's manufactured to the time that it actually arrives on site. So I think really giving some thought to how that's structured is going to be really important. And on the conservative side, one of the things that they've talked about in their platform, which actually just got released today, but is the incentive to have high-density housing in transit-oriented areas. So their platform talks about having building permit-approved sites in transit-oriented areas. So looking at where the puck might go if either party comes into power, and paying attention to that, because there's a few things to look at. So that's what I would say in terms of the different parties and what's coming up for the election. Well, look, I would say there's three main areas that I think are possible areas to explore. So the first area is looking at the CMHC MLI Select program and how their CMHC is now imposing rental achievement holdbacks much more often than they were before, especially for larger projects. And so the opportunity there is looking at mezzanine or conventional top-up financing to top up the CMHC financing to previous levels during construction, and then have that debt taken out by the CMHC rental achievement holdback. So I think that's a really important solution to look at and pay attention to. And some of the pricing for that is, can be quite compelling, starting at prime plus 1 all the way to 10 or 11%, but prime plus 1 today is about 6%. So it's not, it's actually, I think, very cheap debt, relatively speaking. So I think that's one area to pay attention to. The other area to look at is institutional equity partners. So, instead of providing all the capital for a capital stack or trying to raise equity from retail investors, which can be time consuming or, can require a lot of effort, looking at institutional partners that can come into the capital stack, be one partner that can cut a single check that takes your project forward, as opposed to either doing it yourself or raising equity from retail investors. So I think looking at institutional equity, especially if you have a shovel-ready project right now, I think that's a really good opportunity. And then I would say the third opportunity, in times like this where there's a lot of volatility and uncertainty in the environment, you also have CMHC that's pulling back. Right now they're financing 90% of all new construction projects in Canada, and they're talking about pulling back from that. So I think you're going to have an environment where there's going to be less debt capital available. And one thing to consider as a developer or owner of commercial real estate, especially if you're sitting on some liquidity and don't see a project that gives you the returns you want, is looking at getting into becoming a lender. And so lending money and looking at the risk-adjusted returns of that being quite compelling, because you can get high single-digit, low double-digit returns, and being in a debt position, you're more protected in the event of a downturn. And especially if it's an area that you understand or not to say any lender should get into it with the intention of taking over an asset, but in the event that you had to, or that there was an issue, and it being in an asset class or an area that you're familiar with, I think there's a lot of advantages there. And then you can also learn what other groups are doing out there and how they're making returns, because I really think in this market, every pocket, every neighborhood, every type of building is going to be different. There is no one size fits all, or this is what's happening in an entire city. Different projects, different nodes of the city are going to perform differently. And so when you're in that position, you can provide some debt capital, which I think will be much needed in the coming months. I think that's a really good opportunity for people to think about. And then I would say just generally, my general guidance is in times like this, there's opportunities. And in the Lower Mainland, for example, I think there's land is a very challenged asset class, but it also means that that land is on sale. It's on sale at much lower prices than they were a couple years ago. Same with Vancouver multifamily assets or multifamily assets in the Lower Mainland. I think they're on sale. And then I think the other opportunities, if you look at the Edmonton market, and where rents haven't declined the same way that they have in other markets, and they potentially have some room to go up, that's a really compelling value proposition. Same with Calgary. You take Alberta as a whole, and you look at the migration numbers. There's strong interprovincial migration, strong international immigration, strong natural population increases with more births and deaths. You have a really strong demographic force in that province that I think will do really well for multifamily investors there. So I think times like this, it's about focusing on the opportunity, keeping your head and your wits about you, and seeing what's out there and making the right decisions, because frankly, doing nothing is a decision as well, and it may not be the right one in times like this. Yeah, look, I would say, like, in terms of headlines, it's thinking about where we are today, and the decisions you make now are going to impact where you are a year from now. And I would say, like, when it comes to, my background is in financing, and so I'll speak to financing. And in times like this, in volatile times, I would say, I like to say there's three things you got to pay attention to, and there's the three S's. They all start with S. When it comes to financing, number one is speed. And so looking at how fast you can get a rate locked, or how fast you can get a loan approved, or how fast you can get a loan into CMHC. Speed in times like this where there's so much volatility is more important than ever. The second S would be structure. And so structure means, how do you structure your loan? I talked about the top ups for CMHC financing, for example. That's an element of structuring a loan that can be really important. You also want to look at how early can you lock an interest rate in during construction, because there's structures that allow you to do that too. Or conventional strategies that allow you to build a loan without CMHC, but looking at the right structure is really important too. And then finally, I would say that third S is skills in a time like this, which is like, and skills to me goes along with skills and knowledge, and it's the skills of knowing what debt capital partners are doing what at different times. In times like this, you'll see lenders pull back and step in, and pull back and step in constantly. And if you're relying on a single source of capital, even two sources of capital, I think you're putting yourself at a lot of risk. And so I think whether it's building the relationships with numerous lenders yourselves, or working with a trusted broker like ourselves to help navigate through times like this, I think is really important. So, when you're thinking about where the headlines are going to be a year from now, it's about how you manage in today's environment, thinking about things like that.